Bitcoin is holding near the 60K zone, and at first glance that may look like a simple technical story. A major level is being tested, traders are watching the chart, and every small bounce can create the feeling that the market is trying to recover. But the deeper question is not whether Bitcoin can stay above a round number for a few more candles. The deeper question is whether the money behind the market is actually returning, because a price level can hold for many reasons, while only liquidity can tell us whether that hold has real strength behind it. This is where many market reactions become too quick. When Bitcoin stops falling, people often treat that as a sign that the worst is over. But a market that stops falling is not automatically a market that is ready to trend higher. Sometimes sellers simply pause. Sometimes short positions take profit. Sometimes traders defend a psychological level because everyone is watching the same number. These reactions can create a bounce, but they do not always create a new trend. For a bounce to become a real recovery, the market needs evidence that capital is coming back with confidence, and that evidence usually appears through liquidity, flows, positioning, and broader risk appetite. That is why the 60K zone matters, but it should not be treated as the whole story. For the calm metrics, this level is better understood as a market structure test. If Bitcoin can hold this area while liquidity improves, while stablecoin buying power expands, while ETF demand strengthens, and while the dollar stops pressuring risk assets, then the support zone becomes more meaningful. In that environment, the market is not only defending price, it is rebuilding the conditions for continuation. But if Bitcoin holds the same level while liquidity remains weak, while the dollar stays strong, while ETF flows are inconsistent, and while risk appetite remains defensive, then the same price action becomes much more fragile. The chart may look stable, but the foundation underneath it may still be soft. The reason this matters now is that Bitcoin is not trading in isolation. It is moving inside a wider macro environment where the US dollar, interest rate expectations, technology stocks, AI momentum, and investor psychology are all connected. When the dollar strengthens, global liquidity often feels tighter because capital becomes more cautious and investors become less willing to chase speculative assets. When markets believe interest rates may stay higher for longer, risk assets usually need stronger evidence before buyers step in aggressively. And when technology stocks or AI leaders begin to weaken, the entire risk appetite picture can change, because investors start asking whether the weakness is only sector rotation or whether it is the beginning of a broader defensive move. This is especially important for Bitcoin because it behaves like a liquidity-sensitive asset. It does not only respond to crypto headlines, halving narratives, or individual exchange news. It also responds to the question of whether capital is moving toward risk or away from risk. When liquidity is expanding and investors feel confident, Bitcoin can attract strong bids because it sits at the edge of the risk curve. But when liquidity tightens and investors become defensive, Bitcoin can struggle, even if its own long-term story has not changed. That is why looking only at the Bitcoin chart can be misleading. The chart shows the result, but liquidity explains the pressure behind the result. The AI trade adds another layer to this story. Over the past year, a large amount of market attention has gone into AI-related stocks, chips, data centers, cloud infrastructure, and the companies connected to that investment cycle. When AI momentum is strong, capital can concentrate heavily in that part of the market, and Bitcoin can remain stuck because the strongest money flow is going somewhere else. But if AI momentum begins to weaken, that does not automatically mean Bitcoin becomes the next winner. The important distinction is whether the market is rotating or de-risking. If investors are still confident and simply moving money from one crowded area into another opportunity, then Bitcoin could benefit from capital rotation. But if AI weakness is part of a wider risk-off environment, then money may not rotate into Bitcoin quickly. It may move into cash, the dollar, bonds, or other safer positions first. This is why the current Bitcoin setup needs patience. A support hold gives the market time, but liquidity confirmation gives the market strength. The market needs to show that buyers are not only defending a level, but that new capital is willing to step in. That confirmation can appear in several places at once. Stablecoin liquidity can show whether fresh buying power is available inside the crypto system. ETF flows can show whether traditional finance demand is returning or staying cautious. Funding and open interest can show whether the move is being supported by real demand or by excessive leverage. The dollar and yields can show whether macro pressure is easing or still tightening financial conditions. And the Nasdaq can show whether broader risk appetite is healthy enough to support Bitcoin rather than fight against it. When these signals align, a Bitcoin recovery becomes much more believable. But when they are mixed, the market remains vulnerable to false starts. This is why a calm investor should not treat every green candle as confirmation and should not treat every red candle as the end of the cycle. The better approach is to separate price reaction from money flow. Price can bounce first, but liquidity must confirm later. Without that confirmation, a bounce can look strong on the screen while still being easy to reject when macro pressure returns. So the 60K zone is important, but it is not the final answer. It is the area where the market is asking a bigger question. Is Bitcoin building a base, or is it only pausing before the next wave of volatility? If liquidity starts to improve, this level could become the foundation for a stronger recovery. If liquidity stays weak, then the market may continue to feel heavy even if Bitcoin avoids a clean breakdown. In other words, the most important signal is not only whether Bitcoin holds the line, but whether money begins to support the hold. That is the calm view of this market. Bitcoin does not need perfect conditions to recover, but it does need enough liquidity support to make the move believable. Until that support appears clearly, this is not yet a clean breakout story. It is a liquidity test. Price is getting the attention, but liquidity will decide whether the move can survive.